Hi, class. Welcome to Chapter 11. Chapter 11 is going to get into diversification. You know, this class is the 123 class, which is Introduction to Investments. Now, let's really talk about investments. So, portfolio diversification and risky asset allocation is what we shall discuss. This is Chapter 11. So this is something have I think has always been the easiest way to define diversification is just don't put all your eggs in one basket. Which means if one breaks, you may have all of them breaking because they're the same eggs. Don't put them in one basket. Maybe separate 20 different baskets and put one egg in each. So say for example that egg breaks in basket number 12, you've got the other baskets to hopefully survive and to balance out. I think diversification is so important because the industry, that you actually invest in, it could be electric, it could be green, it could be, let's say, Bitcoin. You have to make sure that you have some diversification and make sure that hopefully if something goes down, another product or vehicle of investment goes up. So what you're looking at is diversification allows you to take a loss, but don't lose everything that you have. That's why everyone says, you know what, it's great to invest completely in Bitcoin, but there's no diversification. So right now, the most important thing that I see on the horizon is AI, artificial intelligence, because every single thing we're doing now is controlled, unfortunately, or fortunately, by AI. So artificial intelligence is something we have to embrace and something we have to realize is the sign of the times. So definition of diversification according to the entire world, so to speak, is asset allocation. Asset is what you're actually going to be investing in. An asset could be a stock, a bond, through mutual funds, individual investments, real estate, and so forth. And what you're looking at is trying to not put all of your assets into one industry. For example, I'm not going to, let's say, invest every bit of my money in real estate, or I won't invest it in green, which means solar and so forth, or maybe not AI and not Bitcoin solely. I'm going to take a little bit of each one of those and figure out by percentages which one I want to put more, let's say, money in. So I have 100%. Let's say I have $1,000. I'm going to break that $1,000 down based on the percent of money I'm going to put in each particular investment vehicle. And when you say the word investment vehicle, it just simply means your stocks, your bonds, your mutual funds, 401k even, and so forth. So you think of that in terms of understanding how you should diversify. I had one of my students, which was a really great eye opener for the class, is she says that she diversifies also by timelines. So she's not just saying that she's diversifying based on the products that she's actually investing in. She's thinking of how long she's going to keep a certain amount of funds or money in a particular investment. So she diversifies based on timeline. So 6 months, maybe a whole year, she's going to move things around strategically. Then she's also going to think about how long she's actually going to keep things in a particular investment vehicle. So, so diversification basically, if you are buying bonds, you might choose bonds from different issuers. That's super important. You can think about federal government, state and local governments, and corporations, as well as those with different terms of different credit ratings. So different credit ratings means it depends upon how valued that bond is. We talked about valuation of bonds a couple of chapters earlier. This kind of ties in completely with you being able to choose which particular investment vehicle will work for you. In this case, we're talking about bonds, federal, state, local, and corporate bonds. Diversification through mutual funds is a really great way also to hopefully keep your investment afloat. So diverse with mutual funds, building a diversified portfolio is one of the reasons many investors turn to pooled investments. Pooled investments mean there is a good amount of people coming together who can't afford one big investment. Say, for example, they want to invest in Microsoft or Apple or maybe even Tesla. They don't have the amount of money in terms of buying in. Because, lots of times a company wants you to invest, let's say, at least 100 shares, 100 stocks. Let's say if they're $300 per share, you're talking 300,000, 30,000, and so forth. So that's how you are going to get pushed out of the investment world. So by considering pooling with other investors, such as mutual funds and exchange funds, that's your way of getting into, let's say, a way to you can invest. So pooled investments typically include a large number and variety of underlying investments than you are likely to assemble on your own. So they are spread out and they're a little bit more low risk. Portfolio diversification, you have to make sure that even your investments are solid. So you can go from stocks to bonds to mutual funds to real estate to ETFs, which is exchange traded funds, to a lot of other investment vehicles. A lot of folks stick with real estate based on where you are investing in and what state you're investing in. That can be very profitable. Here in California, it's a hit or miss. Right now, we are the most expensive city in the United States to live. That means that you're going to really, let's say, I'll go back a minute here. The average home starts at 800,000 and above. Now, that's not a mansion. That's a two, three, four-bedroom home. So think about when you do diverse, where you're going to actually invest your money. Now, this is key also to rebalancing. Even though you think you've got a really great portfolio, at what point do you realize you need to maybe rebalance? Which means, although there is no official timeline that determines when you should rebalance your portfolio, you may want to consider whether you need to rebalance once a year as part of an annual review of your investments, every 6 months, every 2 years, whatever you are comfortable with. Which means you're not having, let's say, a brokerage firm manage your investments, you're managing it. Or you would direct the investment firm to rebalance your portfolio on an annual basis. So of rebalancing the role of rebalancing is you can rebalance your portfolio in different ways. Three common approaches include redirecting your money, which means redirecting your money to the lagging asset class until they return to a percent of total portfolio that they held in the original allocation. In other words, you want to go back to your original investment, add new investments, or sell off your assets. Those are three different ways and or kind of procedures, if you would, to rebalance your portfolios. So now we think about solutions. Solutions. All three approaches we just spoke of work well, but some people are more comfortable with the first two as they may find it hard to imagine selling off investments that are doing well in order to put money into those that aren't. The analogy here is think of a food chain like Taco Bell. If one store is not doing well, then they're going to, let's say, reallocate funds to support that store or that restaurant because the other restaurants are thriving. I worked for Taco Bell when I was 16 years old. I was one of the managers, and ours was the highest grossing store in Hampton, Virginia. And we constantly would reallocate, move funds around to support the other restaurants that weren't thriving so well. So approach another approach some investors take it I'm going to take is to invest in life cycle funds, also called target date funds, which are designed to have their allocation modified gradually over a period of years. shifting into focus from seeking growth to providing income and preserving principal. So, in summary, financial experts tend to recommend diversification among and within assets classes. For example, when it comes to stocks, diversification increases when your own multiple stocks, within your own multiple stocks. It increases further when those stocks are made up of different sizes or different size companies, small, medium, and large, including different sectors as well, technology, consumer, healthcare, and more, and are diversified geographically, domestic and international. So there's a whole bunch to consider when you're trying to make sure you have a diversified portfolio. When you get an opportunity, take a peek at the Rich Dad Poor Dad video, and it kind of simplistically tells you how you really can actually diversify your holdings and your investments. With that said, thank you very much for listening to me talk about Chapter 11 and diversification. We'll see you in Chapter 12.